Hi, welcome back. The sessions on value investing, we talked about screening for cheap stocks in value investing. And with value investing, the screens tend to be built around looking for stocks that trade at really low PE ratios or low price to book ratios with decent fundamentals, if not good fundamentals. In this particular session, I want to focus on using screening as a growth investor to find stocks where you can get growth at a reasonable or a cheap price. So the focus is not on getting cheap companies, but on getting companies where growth is being underpriced. So if you think about screening for growth companies, here are some of the things you're trying to do. You're trying to find companies where growth is most likely to be, where you're getting $1 of growth for 50 cents. So essentially using the same framework that a value investor is using, but you're using it in the context of the growth assets. So if you the number of screens that growth investors use tend to be fewer and scarcer than the screens that value investors use, but most of the screens revolve around one of two strategies. One is to look at ratios of price earnings to growth, called the PEG ratios, or comparing price earnings to growth. And the other is to focus on earnings growth itself, looking for companies which are growing fast and are likely to keep growing fast. I want to dispense with the second set of screens first because they're the screens where the empirical evidence doesn't really back up or provide much evidence that it actually works. So here's one strategy if you're a growth investor. Look for companies which have grown fast in the past, which are growing at very high rates, and invest in those companies. That strategy historically has not worked very well for a simple reason. The correlation in growth across time periods is fairly low. What I mean by that is companies that have grown at high rates in the last 3 years, the last 5 years, are not necessarily the companies that will be the highest growth companies in the next 5 years. In fact, if there's evidence, it is that there might be reversal. Companies that have grown the fastest in the last five years often will end up as the companies that grow the slowest over the next 5. There's some difference based on whether you're looking at small companies or large companies, but that's the first problem, is that the growth is not as predictable as we'd like it to be if you're focusing on historical growth. It's also worth noting that historical growth is subjective. Subjective in what sense? It's a function of what time period you use. So basically it depends on your starting and your ending period. So one preferred device for people who want to show high growth is to pick a really bad starting period and pick a really good ending period, and ergo, you got a high growth rate. So those are historical growth-based approaches. Generally, the evidence doesn't back up that you can make much money based on historical growth in earnings. The other strategy focuses on expected earnings growth. So you focus on companies where the expected growth in earnings is going to be highest. I might say, where do I get these expected growth rates? At least for companies in developed markets, you tend to get them from equity research analysts tracking these companies. So what you're effectively investing in when you invest in companies with high estimated growth is companies where analysts are really, really caught up with that company. They like that company. Now that strategy again doesn't have a good track record of success because we know that analysts tend to move in herds. They tend to move together, and that they often tend to overestimate growth at the best companies and underestimate growth at the worst companies. So if there is evidence on earnings growth based strategies working, I haven't seen at least conclusive evidence on it. So if you're going to use earnings growth as part of your strategy, you've got to figure out ways to kind of finesse it to make it work, because using historical growth or analyst estimates doesn't seem to do much. Here's the second way, and in fact, let me back up that point I made about correlation and growth. This graph actually shows you the correlation in growth between for large cap, mid cap, and small cap companies. And the bottom line on this graph, the lesson to take away is, if there is any correlation in growth, it's likely to be highest at larger companies. Smaller companies, which is where you tend to go when you're looking for high growth, the correlation tends to be very, very low. So the kinds of companies where you're focusing on high earnings growth also tend to be the kinds of companies where the correlation in that growth tends to be low. One final point about growth. If you're going to focus on a growth rate, and this is, I think, an interesting finding, it turns out that revenue growth is more sustainable and more correlated over time than earnings growth. So if you're going to build your investment strategy around past growth, I would say make it around revenue growth rather than earnings growth. You're far more likely to be successful. So here's the second strategy. Buy high PE stocks. That sounds like a terrible strategy, right? Look at this graph. Okay? If you buy high PE stocks, whether you buy an equally weighted or a value weighted portfolio, you're going to do a lot worse than buying low PE stocks. In fact, we used exactly this graph to justify a value investing strategy of buying the lowest PE stock. So you're saying, what gives? Well, here's an interesting finding. If you look at the difference between the low PE and the high PE portfolios, it is true that across the entire time period, and this goes back in time to 1960 through 2010, looking across the entire time period, low PE stocks beat high PE stocks. But there are extended time periods where growth stocks outperform value stocks. In other words, high PE stocks beat. So anytime you see the graph drop below the line, these are periods where high PE stocks do better. You're saying, so what? With any strategy, that's going to be true. It turns out that the periods where high PE stocks outperform low PE stocks are correlated with macro variables. Here's one. It turns out that high PE stocks outperform low PE stocks when the yield curve, that's the difference between long-term government bond rates and short-term government bond rates, is flat or downward sloping. So if you have 10-year bond rates being lower than the T-bill rate, or you have a flat yield curve, it looks like that historically at least those are periods where the high PE stocks outperform low PE stocks. So there are macro variables like interest rates and growth rates that seem to be correlated with when high PE stocks do better. So if you can time those cycles, you could invest in high PE stocks in those cycles and actually come away with excess returns. But the key is timing. Now, the more common growth at a reasonable price strategy is to bring in the expected growth rate in conjunction with the PE ratio. And there are two versions of investment strategies that use this combination. In the first, investors just compare, or portfolio managers compare the PE ratio in a company to the expected growth rate in the company. And the rule of thumb is a simple one. If a stock is trading at a PE ratio less than its expected growth rate, it's a good investment. It's a cheap company. If the PE ratio is higher than the expected growth rate, it's an expensive company. Let me back up and give you an example. Let's suppose you have a stock trading at a PE ratio of 10. It's pretty low, right? And its growth rate is 8%. Using this strategy, because the PE of 10 is greater than the growth rate of 8, you wouldn't buy the stock. That's overvalued. Let's say you have a second stock with a PE ratio of 20. That's high, right? That PE ratio, however, is in conjunction with a growth rate of 25%. That second company is cheap because the PE ratio is less than the growth rate. So that's the first version of the strategy. Just compare the PE to the growth rate. Very simplistic, but presumably if you do it, you should make higher returns over time if the strategy works. Here's a slight variant of that first strategy. Instead of comparing the PE to the growth rate, divide the PE by the growth rate. So in the two companies that I gave you, the first one had a PE of 10 and a growth rate of 8. 10 divided by 8 gives you 1.25. The PEG ratio, that's what that's called, for the first company is 1.25. The second company's PE ratio is 20, and its growth rate is 25%. 20 divided by 25 gives you 0.8. So the second company has a PEG ratio of 0.8. You want to buy stocks with low PEG ratios. So in a sense, this is an extension of a PE ratio strategy, but now you're looking for stocks with low PEG ratios. Now, of course, the question with each of these strategies is, does it work? I think the first strategy of comparing the PE to the growth rate is a dangerous one because from an intrinsic value standpoint, there's no reason to conclude that just because a PE is less than the growth rate, that a stock is cheap. In fact, it is easy to show that when interest rates are high, this is going to happen on a lot of companies. And when interest rates are low, very few companies are going to come through on the screen. So what you're actually capturing is an interest rate effect rather than is this stock cheap or expensive. So I would not try the first strategy very long because clearly, if you look at the basics of it, they don't hold up. What about buying low PEG ratio stocks? Here it's a little more interesting. So Morgan Stanley study from the late 90s that seemed to conclude that buying stocks with low PEG ratios would deliver higher returns than buying stocks with high PEG ratios. And that's actually backed up. I actually looked at 3 time periods in this particular graph, comparing stocks from lowest to highest PEG ratios in all 3 time periods. The lowest PEG ratio stocks outperformed the highest PEG ratio stocks by 3, 4, 5%, and more in some periods than in others. For instance, the very first time period here, the lowest PEG ratios did much better than in the very last time period, the blue versus the green. Okay. But before you start celebrating, before you decide to invest in the lowest PEG ratio stocks, here's a cautionary note. PEG ratio is a ratio that is biased towards finding you very risky companies. And the reason is very simple. As growth rates increase, PEG ratios tend to go down for companies because price earnings ratios and growth rates don't move proportionately. What I mean by that is when growth doubles, PE ratios don't double. So as you get to higher and higher growth rates, you tend to get lower PE ratios. The PEG ratios tend to get lower as growth rates increase. Not only that, holding all else constant, a company gets riskier. The PEG ratio goes down, and here's why. For the same growth rate, the riskier company, you pay a lower PE ratio. And in fact, there is evidence that if you pick companies based on low PEG ratios, you pick the lowest PEG ratio stocks, you will actually end up, and this is actually a graph that brings us home, with a disproportionately large number of the highest risk stocks. So for instance, if I break US stocks down based on risk from lowest risk to highest risk, the lowest risk stocks have the highest PEG ratios and the highest risk stocks have the lowest PEG ratios. You're saying, so what? Take the previous page where I showed you the lowest PEG ratio stocks earned higher returns. If you went out and bought the stocks, the 40 stocks with the lowest PEG ratios in the market, you might end up with the riskiest stocks in the market, and then it becomes an open question. You earn more than the S&P 500 or the market, but are you earning enough to cover the risk? So a low PEG ratio strategy on absolute terms beats the market, but on a risk-adjusted basis, at least the evidence suggests that you basically break even. So the evidence on screening for growth stocks is much less persuasive than the evidence of success of screening for passive value stocks. That doesn't mean you can't try it. If you're going to try passive growth investing, you're going to screen for growth companies, then I think you need to bring something to the table on growth. In particular, you need to come up with a way of thinking about growth that gets past historical growth, that goes past analyst estimates of growth. In fact, one way you can think about growth is in terms of fundamentals. A company to grow fast is to reinvest well and reinvest a lot at the same time. So if you have any interest in intrinsic valuation, I'd strongly recommend that you start reading up the literature on sustainable growth and look at how it's driven, because if you can bring something new about growth into the equation, perhaps you can find a way to leverage that to buy the best growth companies. Second, you need a long time horizon. As with all passive screens, even if you're right about low PEG ratios delivering higher returns, that's not going to be over the next 3 months or 6 months. It might require 3 years or 5 years as your time horizon. And third, when you're a successful growth investor, there is a component of you that that basically has to be a macro investor. We saw that with the high PE ratio success. High PE ratio strategies, we said, worked in certain macro time periods when yield curves were flat or downward sloping, when growth is lagging. If you're good at timing those macro shifts, you're also going to be good at exploiting them with growth stocks. So maybe you're a macro or market timer, and that allows you to be successful using screens for buying the best growth stocks. As you can see, being successful with growth investing and screening for cheap growth stocks is more difficult than screening for cheap value stocks. But that might be an advantage. Most people don't even try, and perhaps if you're the one who can bring something new to the table, you can walk away with something special. Thank you very much for listening.